Welcome to our channel where we empower you to take control of your financial future. In today's video, we're going to discuss a topic that's near and dear to many people's hearts: building wealth and achieving financial freedom. We all want to live our best lives, but many of us struggle with how to get there. The good news is that successful investors all have habits in common that you can learn and incorporate into your own investment strategy. So sit back, grab a pen and paper, and let's dive into the 5 habits of successful investors that can help you build wealth and achieve financial freedom. Had a long-term perspective. Having a long-term perspective is a critical habit of successful investors. It's a mindset that allows investors to see beyond the short-term noise of the market and focus on their long-term investment goals. By having a long-term perspective, investors can avoid the temptation to make emotional decisions based on short-term fluctuations in the market. Instead, they can remain patient and disciplined, knowing that investing is a journey that requires time and perseverance. One of the benefits of having a long-term perspective is that it allows investors to take advantage of compound interest. Compounding is the process by which an investment earns interest on both its principal and accumulated interest. Over time, compounding can lead to significant growth in an investor's portfolio. By holding onto their investments for the long term, investors can maximize the benefits of compounding and achieve their investment goals. Another benefit of having a long-term perspective is that it allows investors to ride out market volatility. The stock market is inherently volatile, with fluctuations in stock prices happening every day. By focusing on the long term, investors can avoid getting caught up in the day-to-day fluctuations and instead focus on the big picture. This can help to reduce stress and anxiety associated with investing and allow investors to stay the course. In conclusion, having a long-term perspective is a key habit of successful investors. It allows them to take advantage of compound interest, ride out market volatility, and remain patient and disciplined in the face of short-term challenges. By adopting a long-term mindset, investors can set themselves up for success and achieve their financial goals. Diversify your portfolio. Diversifying your portfolio is another crucial habit of successful investors. It involves spreading your investments across a variety of asset classes, such as stocks, bonds, and real estate, to reduce risk and increase potential returns. By diversifying, investors can avoid putting all their eggs in one basket and protect their portfolio from the fluctuations of any one particular asset class. One of the main benefits of diversification is that it can help to minimize risk. Different asset classes tend to perform differently under various market conditions. For example, stocks may perform well during a bull market, while bonds may perform better during a bear market. By diversifying across multiple asset classes, investors can reduce their overall portfolio risk and minimize the impact of any one asset class's downturn. Another benefit of diversification is that it can increase potential returns. By investing in different asset classes, investors can take advantage of growth opportunities in multiple areas of the market. This can help to increase the overall performance of the portfolio and potentially generate higher returns over time. Finally, diversification can also provide peace of mind for investors. Knowing that their portfolio is diversified and protected from market fluctuations can help investors stay calm and focused on their long-term investment goals. So, diversifying your portfolio is a fundamental habit of successful investors. It can help to minimize risk, increase potential returns, and provide peace of mind. By diversifying across different asset classes, investors can set themselves up for long-term success and achieve their financial goals. Stay informed. The world of finance and investing is constantly changing, and it's important for investors to stay up to date on the latest developments and trends. By staying informed, investors can make better decisions about their investments and stay ahead of the curve. One way to stay informed is to read financial news and analysis. There are many reputable sources of financial news and analysis, such as The Wall Street Journal, Bloomberg, and CNBC. By reading these sources regularly, investors can stay informed about market trends, economic developments, and new investment opportunities. Another way to stay informed is to attend conferences and events. Many organizations host conferences and events focused on investing and finance. These events can provide valuable insights and networking opportunities for investors, allowing them to stay up to date on the latest trends and developments in the industry. Finally, staying informed also means understanding your own investments. Successful investors take the time to research the companies and assets they're investing in, including their financial performance, management team, and industry trends. By doing their due diligence, investors can make better informed decisions about their investments and avoid costly mistakes. Staying informed is a key habit of successful investors. It allows them to make better decisions, stay ahead of the curve, and avoid costly mistakes. By reading financial news and analysis, attending conferences and events, and doing their due diligence, investors can set themselves up for long-term success and achieve their financial goals. Avoid emotional decision-making. The stock market can be a roller coaster ride of emotions, and it's easy to get caught up in the ups and downs of the market. However, successful investors understand that emotions can cloud judgment and lead to poor decision-making. One way to avoid emotional decision-making is to stick to a solid investment plan. Successful investors have a clear investment plan that outlines their goals, risk tolerance, and asset allocation. By sticking to their plan, investors can avoid the temptation to make emotional decisions based on short-term market fluctuations. Another way to avoid emotional decision-making is to take a long-term perspective, as discussed earlier. By focusing on the long term, investors can avoid getting caught up in the day-to-day fluctuations of the market and stay focused on their investment goals. Finally, successful investors also practice mindfulness and self-awareness. They understand their own emotional triggers and have strategies in place to manage them. This might involve taking a step back from the market when emotions run high or seeking advice from a trusted financial advisor. Avoiding emotional decision-making is a critical habit of successful investors. By sticking to a solid investment plan, taking a long-term perspective, and practicing mindfulness and self-awareness, investors can make better decisions and achieve their financial goals. Have a plan. Having a plan is one of the most important habits of successful investors. A solid investment plan provides a roadmap for achieving your financial goals, and it helps you stay focused and disciplined in the face of market volatility and uncertainty. A good investment plan should start with clear and specific goals. Whether you're saving for retirement, a down payment on a house, or your child's education, your investment plan should be tailored to your specific needs and objectives. Once you've identified your goals, the next step is to develop a strategy for achieving them. This might involve selecting specific asset classes or investment vehicles, such as stocks, bonds, mutual funds, or real estate. It might also involve setting a specific asset allocation, or the percentage of your portfolio that's invested in each asset class. Another important element of a solid investment plan is risk management. Successful investors understand that investing involves risk, and they have strategies in place to manage that risk. This might involve diversifying your portfolio, investing in low-cost index funds, or using stop-loss orders to limit potential losses. Finally, a good investment plan should also be flexible and adaptable. Market conditions can change quickly, and successful investors are able to adjust their plans accordingly. This might involve rebalancing your portfolio periodically or making adjustments to your asset allocation in response to market trends or economic developments. Having a plan is a crucial habit of successful investors. By setting clear goals, developing a sound investment strategy, managing risk, and staying flexible, investors can achieve their financial goals and build long-term wealth. Building wealth and achieving financial freedom is not an overnight process. It requires discipline, patience, and a commitment to good habits. The 5 habits we've discussed today: having a long-term perspective, diversifying your portfolio, staying informed, avoiding emotional decision-making, and having a solid investment plan, are all essential elements of a successful investor's toolkit. By adopting these habits and incorporating them into your investing strategy, you can position yourself for long-term success and achieve your financial goals. Remember, investing is a journey, and it's important to stay focused on the big picture and avoid getting caught up in short-term market fluctuations. So, whether you're a seasoned investor or just starting out, we hope these tips have been helpful in your journey toward building wealth and achieving financial freedom. Thank you for watching, and happy investing.